Good morning, everybody, to Interactive Brokers webinar program. This is Andrew Wilkinson, Director of Trading Education, coming to you live from New York State. Joining me today, I am delighted to have with me Managing Partner at FSInsight, Thomas Lee, CFA, and he's going to be talking to us about a strategy outlook for 2021. What an exciting year. Thomas, welcome to the webinar.
Thank you, Andrew.
We can see your screen perfectly. We can hear you perfectly. Just a couple of housekeeping notes. I'm going to go on mute in a minute and hand over to Thomas. Please hold your questions to the end of Thomas's presentation. I think he's going to run for about 30-35 minutes, and we'll engage in the conversation to answer any questions that we can at that point. And I'm also going to show attendees today and anybody who visits the recording, which will be out live later today on the Interactive Brokers webinars page, how to access FSInsight, which is given to you free in Trader Workstation through the end of February. So we'll come to that at the end of the presentation and before we take on some questions. Thomas, I'm going to go on mute and leave you to it. Good luck, sir.
Great, thank you, Andrew. And welcome everyone. The things I really want to cover today is, our general feeling about 2021, what we can expect from markets. I do want to talk about some key investment themes, things that run more than a year, because as you know, the stock market has become very thematic. And I think you can have an edge if you can sort of find yourself in the right vector, because you'll have a better probability of finding winning stocks. And then I do want to also in this conversation cover like the last couple weeks, because I think that what happened the last couple weeks probably is changing our base case for the stock market. And so I'll kind of walk you through our base case and then pause and explain why I think the last couple weeks might have changed it. And so I'll go from there. And I hope to run till like 10:30, and then hopefully we have questions. So I'm going to start with just some risks, okay, before I sort of dive into my conversation. And I think that you have to keep in mind it's the stock market has a lot of things that can go wrong. And let's be honest, I mean, the last 10 years, it's all been about a lot of things that could go wrong. And 2020 really brought that to fore. And as I think about 2021, I mean, I just think a ton of things can go wrong, but that's actually healthy because, markets climb a wall of worry. But number one, future is obviously uncertain. We have no idea what COVID's going to do. I mean, the COVID is mutating already, and we had some election turmoil, but that seems to be settling. We have concerns how effective this COVID vaccine could be. We are seeing hopeful signs, but we don't know. The dollar could either crash or soar. Interest rates could surge. We could be in an IPO SPAC bubble. There could be a retail trading bubble. People could be too bullish. Congress could go after big tech. Our new president could have health issues. And of course, some nation can hack the US. So look, I'm going to just start. I really want to start with this because it's not like I want to tell you everything's rosy. A lot of stuff can go wrong, but that's the great setup because, as you know, stocks climb a wall of worry, and of course, you tend to want to counter trade consensus anyways. So I'm going to now advance and talk about 2020. And I only want to spend a couple minutes on this, but I think it's important to emphasize because I think 2020, as chaotic as it was, and it was really difficult. I know it's difficult for everyone, so I'm not saying 2020 was a breeze. But one of the things that I think people forgot is how important symmetry is to market structure. I think that when 2020, we had that crash in February, the thing I heard from almost every client was, oh, well, we're crashing. It's going to take forever to repair. That's why I'm giving up on stocks. But actually, for those who are clients of ours, we produced this chart in March, actually the March 24th, because one of the things that we thought was really important to keep in mind, and we've used this during my time at JP Morgan is that the faster you fall, the faster you recover. So we are believers in market symmetry. And so just to make this clear, we were highlighting that in the 10 times the market fell more than 35% since 1920, the recovery was symmetric. So if you fall fast, you bounce fast. And that was our playbook for 2020. And as you know, that was really defied a lot of skeptics. So I think that's important to keep in mind. Whatever happened last year was not unusual. It was literally a textbook symmetric recovery. Now, then let's switch gears, okay, because that is behind us. And now we want to know, well, how do we want to be positioned in 2021? Well, look, I think we got to keep these 6 things in the back of our head. So I already told you about the risks, but let's think about the bigger picture. We have a new expansion starting, a genuine one. I mean, the PMIs don't lie. We had a depression and now it's turning. And we have the central banks dovish, really in an unusual way. So we have a long runway for a dovish Fed. Real interest rates, not nominal, but the rate of interest less inflation is going to be the most negative in 70 years. I think you got to let that sink in. I mean, I know people are looking at the nominal 10-year level, but there's a chance that negative rates could even be more negative this year. That's like free money. You want to invest capital in that environment. The credit outlook is actually positive. As you know, a lot of credit analysts are saying the default cycle's peaked. And this 5th one's really important. There's a lot of scared money out there. I mean, a lot. You might think people are bullish because stocks are up. It's not true because number one, the world and US households are synthetically short equities. Institutions and hedge funds are in theory overweight stocks because households are underweight. But right now, if you had to say which direction are things going, households will need to increase their ownership of stocks. So there's going to be net buying of equities. And then I think the risk of inflation probably is reversing. So instead of deflation, there's a risk of a reflation. And so what is the bigger overarching theme? Okay, so I listed like the 6 things that I think make this year, but the bigger story is this, that the stock market proved that it is unkillable. And you want to buy unkillable stocks now, because if they survived the Great Depression, which was greater than the depression in the 20s, these are extremely resilient companies. Okay, well, how do we sort of picture market structure evolving this year? And this is what I think is key. So if last year was about symmetry, this year is cycle reversion, okay? And they're literally overlaying everything I just said. Number one, there's a net income margin cycle reversion. There's going to be a huge margin recovery. I'll show you why, but it's going to be textbook. And if it's textbook, people are underestimating how much earnings will recover. And if that's the case, then there's a ton of upside for those who are ahead of that. There's a huge investment cycle reversion coming. It's a triple whammy. We got an inventory cycle coming, we got a housing cycle taking place, and a CapEx cycle. I'm not sure this has actually happened in our lifetime. We are talking about a triple whammy of investment spending coming. And then we got the Vix reversion. I might even say that this could be the single most important tactical argument to make this year. Again, I'll explain why, but this is a key thing. I think there's a huge volatility regime change coming. And then I think that's going to help. Those 3 above things are going to trigger a value rotation. So a reversion back to owning value over growth. And then finally, I think that you're going to see households shift away from their synthetic underweight in stocks to an overweight, which is a huge tailwind for PE. Okay, so let's see. So that gives us to a roadmap. Okay, this is our rough roadmap on slide 10 for 2021. And originally, our thinking was that the S&P would rally to 4,000 between February and April, and then correct to 3,500 in the first half of 2021, and then bounce big to 4,300. Now that was our base case, and I'll explain why we came to this base case, but it's really simple. We're on slide 13. We have just used this mental overlay. Well, this new market looks a lot like the 82 to 92 period, or 2009 to 2019. So let's just say we're trying to find analogs in those 2 years. 2 cycles seem similar, and this is where we're tracking. Well, if that's the case, both had a pause that started, one of them started, on the 313th day, which is the equivalent of end of January this year, or on the 410th day, which is the end of April, early May. That was how we got the February-April window. But in the last 2 weeks, we had a lot of chaos, which was triggered by these Reddit stocks. And what it resulted in is 2 things. One, it led to a spike in the VIX, one of the fastest ever surges in the VIX. And that chaos also created the largest hedge fund deleveraging, or they call degrossing, episode in history. Like, so never have hedge funds been so quick to get out of stocks. Well, here's why I find that interesting. Number one, if we look at the corrections that have taken place through the last 5 years, they're almost always a result of a degrossing episode, because the stock market either is extended or people are too ebullient. And usually hedge funds are leading the degrossing. Well, that's what just happened. Hedge funds literally degrossed. You know, long only guys typically stay 100% invested anyways. The only people you really see leaving during a correction are hedge funds. And we know, in fact, last 2 weeks were so bad that we actually had multiple storied hedge funds, the smartest guys, see double-digit losses. That's crazy to me, because that means that the risk models were overwhelmed. And when the risk models are overwhelmed, that means people obviously sold even more. So I think you had indiscriminate selling last 2 weeks, a high velocity impact. I think that was the correction. And so I'm now in the camp that we already had the first half correction. And in fact, maybe one of the best proofs of this, and we did write an alert to our clients. And again, if you want to be a client, you can find us at FSInsight.com. But it's that the VIX saw the fastest 3-day decline in the entire history of the VIX. And if you look at just the top 40 episodes of the VIX dropping quickly, and this is the number one, 87% of the time the market's higher 6 months later. And if you exclude 08, because there were 2 episodes in 08, it's like almost 90%. So the bottom line, the degrossing last week plus the collapse in the VIX probably means the bottom is in for stocks for the first half. Now things could change, but that is how our base case has evolved. So I guess what I'm saying is, if we go to page 10, I think this first half correction already took place. And you know, we got to 36 something, so it was close enough to 35. So I want to then turn to page 14 and talk about our sector recommendations. And I think, you know, being thematic and sectoral matters a lot this year. So our, you know, number one, if you look at the market, it's 2/3 of the S&P is growth and defensive. That's 20 trillion of the 30 trillion. And only 1/3 of the S&P is cyclical if you exclude technology. And I'm overweight, my recommendation, everything that is cyclical this year. So consumer discretionary, industrials, energy, financials, materials. And I'm also overweight recommending technology. And as you can see, our global strategist, Brian Rauscher, who is recently joined us, but is exceptionally good at fundamental tracking of the market and earnings. He's also overweight only tech in the growth area. and then overweight everything in the epicenter except for financials and energy. And he has an underweight on energy, but that's understandable because he is earnings focused, and earnings revisions are pretty bad in energy. So I think that's where the market can actually change its mind. And you see these little blue circles. I've ranked my top 3 favorites for this year. So my top 3 sectors to overweight this year are discretionary, industrials, and energy. And of those, okay, I would say the most consensus is consumer discretionary industrials, because like everyone's going to recommend them because that's what you do when if you think we're cyclically recovering. But I think energy, which is my number 2 pick, is actually a non-consensus overweight. And I'll explain why I want to own these 3 groups. Foremost, there's a fundamental overlay. Take a look at consumer discretionary. You know, they're highly levered to a recovery of the economy and end of the pandemic, huge recovery, you know, leverage to both. There's a ton of pent-up demand. There's a lot of operating leverage. You know, in 2000, we wrote a lot about this last year, but in 2008, discretionary companies, when revenues were 10% less than prior peak, had 20% more net income. And that was in 08. That kind of operating leverage, I think, is going to come back in a bigger way in this cycle. So that's why I'm actually quite bullish on discretionary. Industrial, same thing. They're levered to the end of the vaccine. But then remember, there's that triple whammy I was talking about. Inventory cycle plus global CapEx plus housing. And then here comes energy. So energy, I think, is the most attractive because it's the first real improvement of supply-demand dynamics in this sector's history, in almost 20 years. I mean, it's probably mirroring what you saw in 08. And that's because there's a supply constraint from the White House. And there's capital scarcity because private equity is not going to bail this group out again. And then there should be a demand recovery because when people start traveling, you know, you're going to use a lot of jet fuel and, you know, cruises, et cetera. And so and it's also non-consensus. But let's look at the price charts for these things. And this is why I think you got to be bullish. I mean, look at discretionary. This is a 90-year price history, ex-Amazon. And you can see there's this important trend line that discretionary is bounced off of. So I think you're at the bottom range of this, you know, huge trend line. And I think it's going to go back up to the upper end of that trend line. And same thing with industrials, you know, that it looks like it's bounced off an important level. But I think energy is the most interesting. I mean, here it is, you know, the group's been so bad that you have, even in the last 90 years, energy has never been this bad. In fact, it was gonna, you know, this was sort of the line to watch in 2020 and it collapsed through it. So not only is energy not only 90 years bad, it's probably the worst since like the days of whale oil stocks. I mean, that's how bad energy is. And so to me, energy is a structural underweight. Most institutions have 0 weight in it, but it's a group that's seeing a really substantial improvement in supply demand dynamics. So I think it's actually, you know, a fundamental overweight. And here are some stocks. You can flip through those when you download the presentation. We actually have stock lists. We call these trifectas. But I do want to jump to volatility because I think that this is the most important environmental change this year. And what I'm highlighting here is in 2020, this is the VIX, and I'm circling with my mouse, hopefully you can see it. The VIX averaged 29.5% last year, 29.5 last year. That's an incredible level of volatility. And that's why it was a tough year. If you guys had a tough year trading, I don't blame you because the VIX was so insane. It's the 3rd highest average level in history. 2009 and 2010 were only worse. But look what happens. Once volatility normalizes or peaks, you can see that over the next 3 years, it actually leads to a collapse in the VIX. And I think that that's maybe the roadmap for the next couple of years in the US. And more importantly, as many of you guys know more than me, is that the VIX is actually more actively traded through futures contracts. And so it's kind of helpful to look at the term structure of the VIX, or just, future VIX. And in 2020, this blue line is the average VIX. You can see that it actually had a really strange shape. It was pricing in higher volatility in the near term than in the long term. It's the opposite of the long-term history. The gray line is the long-term history. So you can see that historically, the VIX is usually lower at the front end, and then there's term premia for time making it higher at the long end. And then this is where we are now. So you can see that VIX has improved from where it was in 2020, but it's still messed up. And the reason it's messed up is that after month 3, okay, so start looking at month 4, the the financial markets are saying volatility is expected to be the same as it was last year. Like, in other words, the financial markets have not, and that's actually implied volatility, have not given up their fear that 2021 will be like 2020. So I think you got a lot of scared money still out there, measured by the Vix Futures, and I think it's going to collapse. And what happens when it collapses? Well, take a look at this. This x-axis is the spread of the VIX 4-month less 1 month. And the y-axis is the 12-month forward return to the S&P. And last year, the VIX was inverted for the entire year. And this is the red box. This is 10th decile. So the 10% of the instances where people were the most scared. And you can see there's not a single forward return that's negative. The S&P has never had negative forward returns when the VIX term structure is this messed up. So that's my point. You should just bet on fear. Your backdrop this year is that fear is too high and it's coming down. And I don't, for those who are clients of FundStrat, either professionally or through FSInsight, you're probably aware probably every other note is about the VIX. And the reason we're writing so much about the VIX is I think it's one of the keys to this year. And then it's also a key tactical signal, because then if you did the same chart, okay, 12-month minus 1 month, compared to the relative return of epicenter stocks versus growth, 84% of the time, epicenter beats growth. So in other words, this inverted VIX, when it normalizes, is a huge cyclical signal. So it's kind of why we kind of keep beating the drum on overweighting cyclicals this year. And I'm gonna just then breeze through a few more of these slides, because I want to stop at exactly 7 minutes from now. You might say, okay, stocks are expensive, so in fact, I hear people say, Tom, you can't have a new bull market when valuations are high. In fact, a lot of people are saying that to me, and they're saying it to me as if I'm disregarding valuations. Okay, so I got to make 2 comments about that. Number one, whenever you're at the bottom of a cycle, earnings are low, which means multiples are high. So, and actually, all of you guys know, because I used to be a single stock analyst. I did wireless for many years, and I did small caps before doing strategy. As you know, when the rule of thumb is with cyclicals is you always buy when the PE is high and you sell it when the PE is low, because at the peak of the cycle is when the PEs contract. So you can't take a PE and then declare something's expensive, because you need to have it in the context of the regime. But I think the second argument for why you can't get hung up on valuation is the bond market has already proven in history that you would have made a tragic error, okay? So number one, look at PEs now. Investment grade bonds, if you look at the coupon, you're buying them for 52 times versus the S&P at 20. Prior to 2008, almost never, for 50 years, the equity PE was always above the bond PE. meaning at this moment, stocks are super cheap against bonds. But that may not be persuasive. Let me just explain something that is important. If you go back to 2008, when the Fed essentially started to embark on some unprecedented monetary policies, by 2011, okay, so 2011, the yield on the 10-year and the yield on investment grade and the yield on speculative grade junk bonds were all at 40-year lows. Like they were never this low. So in 2011, you would have been at the same juncture you'd be with the stock market today. So literally like 10 years ago, the bond market had the same moment, which is, look, the 40 years, I mean, these are levels that make no sense. And imagine if someone wanted to fade the bond market in 2011. They'd be out of business because, as you know, from 2011 to now, it's been a huge bull market for bonds. In fact, today, the yield on a speculative grade bond, okay, it's so junky, it's not even covered by high yield desks. It's called triple Cs. Have a lower yield than investment grade did in 2000, on the average yield of investment grade bonds through 2006. So think about that. Today, you can fund a triple C company. Speculative grade doesn't even have a credit rating. It's that bad, at lower than what investment grade bonds were funded at for 50 years. So that's what happened in the bond market, and it's persisted for 10 years. Then you have to think about what that means for the stock market today, which is, I think the PEs are going to go way up. And so that's the key. And I want to just sort of rush through a couple more of these slides. On slide 31, this is a key chart. See, cyclical margins, which is the blue line, EBIT margins, collapsed in the GFC, and they collapsed last year. Look how fast they typically recover. This recovery is going to be even bigger because we got stimulus, plus we got the re-engineering. And that's what I doubt people have modeled this in. That's why we're saying S&P earnings this year could be even, exceed 2019 levels on much less revenues. And here's our themes. The 5 themes. There's actually 5. We added a 5th one after we published this outlook. This data is from December. One is the supply chain moves back to the U.S. from China. And the second is that we think there's going to be deurbanization as a real thing, and that's pretty systemic. Number 3, that people work from home, and people are going to buy American. That's sort of policy now. I think the 5th theme is violence in America. I think that there was even data today on gun registrations are through the roof. So I think that we have to keep in mind that America is a lot more violent, and that's not due to the economy. A lot of it's social factors, but it generally takes years to reverse that slippage. So I think that it's something that's very good for technology companies that provide security, but those are investment themes. And let's see, I'm running out of time, so I'm just gonna highlight a few more things. And I guess the last thing I want to highlight is how much of this is probably generational. Okay, and so this is the chart on slide 60. And this is the number of people in America age 30 to 50, but it's the 5-year growth rate. So you can see it's actually very cyclical. It's hard, people tend to think that it's constant. It's not. There's a lot of cyclicality to the size of the population because it has to do with like when people have babies or if they don't have babies. And here's what's interesting is that if you look at inflation, not surprisingly, it's actually really linked to the number of people aged 30 to 50 in America. So if it's accelerating, CPI tends to accelerate, and when it's decelerating, CPI tends to fall. And because of that, I think we're entering a period where reflationary pressures are starting to increase, and that's why it again becomes a pretty big tailwind for equities, because equities tend to like inflation much more than bonds. So with that, I'm gonna sort of stop it here and turn it back to Andrew.
Thomas, that was a fascinating insight into what's going on at the moment. There's a tremendous amount in your PowerPoint there, and I'm just going to remind everybody that that PowerPoint or PDF is available from the handout section on the GoToWebinar panel. So you can click the link and download that and go through the rest of Thomas's presentation. Fantastic information. If you have questions, please put them into, they're coming in now. We're going to come to the questions in a minute. Please put your questions in at the question panel. Tom, if you can have a look over the question bank, and I'll read some out, and we'll get to those in a minute. I just want to share my screen and show viewers. I want to show my screen and take you into Trader Workstation so that you can see how to get FSInsight in TWS. So I just want to make sure that you're all seeing this. Yep, so you're seeing Trader Workstation. To access TWS, to access FSInsight, come up to your new window drop-down menu to the upper left, and under Information System, I'm highlighting Analyst Research. And through the expansion arrow there, you will see that there are two sections here, subscribed and available for subscription. Right now, through the end of this month, you can access FSInsight for free. And if I click on FSInsight, you'll see that we actually get a little window here. And I would suggest that you pin this, keep it open when you close down Trader Workstation at night. And you can use the push pin there to keep the window on top. And access this fantastic research from Tom and his team at FSInsight through the end of February. You can subscribe to FSInsight on a monthly basis using Client Portal. You'd go into Client Portal, go to Settings and User Settings, and then configure your research to subscribe. But through the end of February, you can access this for free within Trader Workstation. If I click through the latest article there, you'll see what happens. We get the feed populates into that window. And here's the FSI blast. Historic 3-day VIX collapse is a signal. Changes Tom's base case for a peak in February to April. So you can see all those articles going back. I don't know how long that goes back by, but the dates on the right-hand side, you can search within the search bar. That's where it's available. So Tom, I'm going to have a quick look at the question bank here and open those out. And are there any you want to address immediately, or do you want me to just read out to you now, Tom?
It's up to you, Andrew. I mean, I know that there's probably if you want to talk about crypto, maybe we can start with some crypto.
Okay, let address Mo's question here. He says, please show your stock recommendations. Mo, as I said, the handout is available in the GoToWebinar panel there. It says handouts. You can click the link and access and pour over that to your heart's content. I want to find that one that referenced Bitcoin. What is the outlook for Bitcoin, asks Jeff. Do you want to take that one, Tom?
Yes, glad to. For those who might be familiar with our work on crypto, we've been writing about Bitcoin and recommending a 1% allocation since 2017, when Bitcoin was around 2,000. And if you followed the work, the thesis was really around two things. One is that it's actually remarkable technology. It's digital money that's incredibly secure. There's no double spend, never been a hack, but it's a really great way to transfer and store value, but with low fees. But the second thesis was that it's a generational thing, that younger people who have digital lives generally are embracing the idea of digital money and through their digital life. And of course, in fact, in the last 10 years, 75% of all GDP growth has been digital. So, it's actually a fact. Our global economy is becoming more digital anyway, so we may as well use digital money. So we're structurally bullish on Bitcoin. I actually think that a lot of what we're seeing in terms of retail interest in stocks and through Reddit is symptomatic of how important millennials are in terms of impacting markets. And one thing that we I've spent a lot of time looking at is, you know, how much that this millennial could impact the future. But the reality is, millennials are about to become the richest generation within a few years, and they love digital assets and they like stocks. I think it's a tailwind for both.
Okay, very good. Thank you for that. There's another question here. When's it back up to? So I don't want to put you on the spot for a recommendation for an ETF here, Tom. That's not why we're here. But Jonathan asked the question, are there ETFs that are value oriented that have high exposure to epicenter type stocks and sectors? So, I mean, you might want, somebody asked the question earlier in the session, and I think you explained it, but you might want to just kind of go over it again to define the epicenter. But is there other ETFs that would that for people to monitor?
Yeah, it's a great question, and I guess what I would say is, number one, the epicenter stocks. It is really companies that were at the center of this pandemic who've gotten harmed, not because of poor mismanagement, but they simply can't be businesses in a time when there's a disease ravaging the world. And that's travel and leisure, so gaming and casinos and hotels, cruise lines, airlines. It's a ton of consumer discretionary companies, because these companies, obviously, it's not a normal, we're not in a normal environment. It's theaters, it's entertainment, it's even things like Harley. And so our epicenter group, which we've listed in the presentation, we have stock lists called trifectas, because they're stocks that are quant likes, are global portfolio strategist likes, and they're technically attractive. So that's our sort of trifecta. But if I was trying to find a proxy, the one that we've been using is SPHB. It's the S&P 500 high beta index. I think it's a decent proxy because it doesn't have that much tracking error to our epicenter index. So that, I guess my answer is SPHB is probably the one we found is the most approximate for the epicenter trade. The problem is you're overweighting financials in it, but that's probably the only difference, because we like financials, but that's giving you a lot more exposure to it than we would.
So, Tom, there's a lot of great questions coming in, and I want you to take as many of them as you can. And I know we're restricted on time, but I just want to put into the chat the question bank for everybody to reach Tom and the team at FSInsight after this event. Please use the email address inquiry@fsinsight.com. I got that right, Tom?
Yes, that's correct.
Okay, that's inquiry@fsinsight.com, and you'll be able to reach Thomas and the team at FSInsight. Let's have another look at the question bank here. Tom, do you want to address Ankit's question? He says, what's the take on emerging markets? Do you want to take that one?
Yes. Now, I don't generally cover EM, but our global strategist, Brian Rauscher, does have a view. He's overweight EM because his rationale is, if you want to be overweight inflation and cyclical and even epicenter, you find more of it in the EM indices. China is like 60% of value index, and EM in general is well over 50%. Whereas, as you know, the S&P today is only 30%. So if you're buying the S&P, you're still buying a tech growth index. Whereas if you buy EM, you're buying true cyclicals. And the pandemic has been global. So I think it's actually pretty rational to do that.
All right, and I hope that answers Thomas's question there. He says, please talk about EM. On the PE valuation chart, you show a PE of 14. Many EMs have leverage to the themes that you like, such as energy, materials, industrials, and the epicenter. Why not more love for them?
Again, I guess I'm you may not want to misinterpret why we're not more EM. The reason we're not more EM is my focus and our institutional universe of clients cares more about our US views. So our
Yep.
work tends to be domestic focused, but Brian Rauscher, our global strategist, actually does global stocks. So he'd be a lot better to talk to about it, but I'm sharing his views. He likes EM.
Yep. Very good. I don't know if you want to take this one, just came in from Cal. Do you think the short squeeze, the recent short squeeze caused by WSB will continue? I assume that's Wall Street banks. Maybe I'm missing the point.
Oh, WSB is Wall Street Bets. It's a Reddit channel.
Okay.
And the question about the short squeeze, it's a really great question. I mean, number one, I don't know if any of you guys spent time on WSB. I think those guys, there's a lot of thoughtful guys there. I mean, some really good fundamental. But
I know my second eldest son spends a lot of time on it, and he's doing okay.
yeah, yeah, some guys on there made a fortune. So I'd say, you know, I think that there's a lot of good work done there. But on the short squeeze, you know, you know, Prime Broker has better data on what the borrow is on a name, and so I don't know. But I would say unless hedge funds reloaded on their shorts on GameStop, which I think a lot of desks would be, I think people would say there's better game to hunt. I would think the short covering largely has taken place.
Okay. We're getting specific questions on sectors. I'm just going to mention three. We've talked about Bitcoin, so I'm going to delete that question. Lynn Han is asking about real estate, and somebody else further down here is asking about healthcare. Do you want to talk about both or either of those?
Yeah, let's see. So real estate and or healthcare really is the question, right? Yeah. I think that okay, so with regard to real estate, I am really constructive on real estate, like the actual physical buy land, but own a home, because we're now in a reflationary period. So the one thing that's the most positively levered to inflation is actually housing. So I'm very constructive on real estate. But in the equity market, that's not what you're actually buying when you buy real estate stocks, because you know you're buying REITs, which are really financial structures that borrow. It's really a spread game. So I don't have a view on REITs. I'd say if you have real estate, like you're about to buy a house, I think it's brilliant. And then on healthcare, you know, I'm neutral on healthcare. I think it's a great, you know, long-term hold because, you know, there's a lot of structural reasons to like it. But, you know, is there a lot of sizzle this year? I mean, I just think that there's going to be a lot more interesting things happening in epicenter stocks this year.
All right. There's two different questions coming in, but basically on the theme of gold and silver. You want to touch on those?
Yes, I like gold. I'm a fan of it. I don't actually own any gold, but I understand look. I mean, gold's endured over the centuries, right? I mean, it's beautiful metal. It's been used as a store of value. It actually has industrially useful because it's a great conductor. Supply isn't as constrained as people think it is, because even though it's an extractive commodity, there is like 1 million times more gold inside the earth than there is above the earth. And actually, I went to visit the gold mint in Australia 2 years ago, and I learned that most of the gold deposited on the earth came from asteroids anyways. So there's actually a lot of extraterrestrial gold out there. So maybe SpaceX might pick up a bunch of gold on its way to Mars, and if it does, then you know it's not good for gold. But I'm not opposed to gold as a store of value. I just don't think people should have more than like 5% or 2%, you know, as a hedge. And then silver, I don't have a view on at all. I think it's I think silver is, yeah, I don't have a view on silver.
Okay,
actually.
no problem. I'm going to take this one from Ethan. What will the inflationary impact be on the markets?
It's a good question. I don't know, actually. That's something we need to watch out for, because for the last 10 years, inflation's been falling. So all of us have spent the last decade getting comfortable with the idea that there's no inflation. I mean, you can tell by bonds just went down. So in the past, inflation's actually good for earnings. And it's good for capital spending. So those are both good for stocks. But I think we just have to watch. I don't know. It's something you got to watch. It's like you got to watch the dollar. I don't really, it could be a wild card.
Right. Larry's asking the question, this is back to Bitcoin, but do you have any favorite indicators for analyzing Bitcoin? Yeah, that's a good question.
Yeah, we have a couple of models for Bitcoin. Dave Greider has taken over one of them, but one of them uses it's essentially a network value concept, and it's got a high correlation to Bitcoin. That model actually says Bitcoin. Well, I mean, again, I think you want to be overweight Bitcoin. I obviously don't want to say things that are too outlandish, because I know there's mixed views on it, but it would be bullish. And then, of course, we have this other thing called the Bitcoin Misery Index, which measures how people feel owning it. And generally, it only provides signal at the extremes. But right now, the Bitcoin Misery Index isn't saying people are ebullient or bearish. They're right in the middle. So I would say there's no signal in Bitcoin right now.
Very good. Vincent is asking, are oil futures a solid investment at the moment? If you want to kind of dance around that one, what are we thinking about crude oil?
Yeah, I mean, futures have a lot of leverage. So I'm not really qualified to tell you whether it's a good bet to be doing futures versus an ETF, but I guess I would say, to me, oil. Look, I'm bullish energy stocks, so I guess I'm bullish oil, but it doesn't mean that I would be buying oil futures.
Right.
I don't know anything about oil futures.
There was a question came out. Oh, any thoughts on the dollar in 2020, and can it pressure commodity prices? And then we're getting another question in about copper. So maybe, do you want to address commodities and the dollar in general?
Yeah, I mean, first of all, currencies are unpredictable. So, you just have to watch what is happening. Dollar strength is not really good for stocks. So if the dollar gets too strong, it's going to change views fundamentally, because it chokes earnings and it chokes the PMI. And on copper, copper's giving us a big bullish. Commodities are giving us a really bullish signal right now, because they're about to break into all-time highs. I mean, I would say commodities is really big signal right now. I mean, look at the CRB index. I mean, there's real breakouts.
Question from Jeffrey. He asked, what risks would change your bullish outlook if they were to come to pass? You outlined quite a lot of risks at the very start of the presentation, Tom. What might derail your view here?
I mean, I think all of the above I outlined. I think COVID could go out of control again. The vaccine could fail. Dollar could get too strong. I mean, I think you should just go back to that list, and literally everything could actually change the view.
Right.
There's a lot of things that could go wrong.
And I guess Adrian's question is, what impact do you foresee of the government change and clean energy? I mean, again, all risks, right?
Yeah, and clean energy is really big opportunity, because whenever you change policy, government picking winners and losers, capital moves, they're going to give incentives. That's why it's that whole green energy, clean energy, EV is a real opportunity.
Tom, there are so many questions come in here. I am going to forward you all of these questions, and hopefully you'll be able to kind of engage with people on some of them. But we're coming up to the end of the session. We've had a fantastic turnout on this one. I'm going to post this presentation, this event, to YouTube later on today on the Interactive Brokers YouTube channel. As I say, the handouts are there for you to all digest everything and more from Tom and colleagues at FSInsight. Fantastic presentation. Tom, please please repeat that email address one more time for the folks to get hold of you, and I think we'll call that a day.
Great. It's inquiry, so INQUIRY at FSInsight.com. FS is like funstrat, insight.com. So FSInsight.com. And yes, we do watch that email. We will get back to you. So shoot us the questions. But mention you were on the Interactive Brokers call, because we get a lot of random solicitations that we usually ignore. So.
Yeah. And just to reiterate, folks, don't forget, inside Trader Workstation, go to that new window drop down, look under analyst research, and you'll see that you will be subscribed for free to that fantastic news feed with plenty of excellent articles from Tom and his team. Please do take advantage of it. And as I say, if you wish to subscribe after that period, please go into Client Portal and configure your subscription to FSInsight. Tom Lee, thank you so much for joining me. It's been a great session. I hope to have you back on the webinar channel at some point in the future. Final words to you, and I'll say goodbye.
Great. Yeah, well, everyone, thanks for tuning in. I think, 2020 was tough. I understand why it was tough. I don't think 2021 is going to be easier, but I think we highlighted some of the things to watch for, and I think we'll end up in a better place, but, it's going to be tricky.
It might be a tough journey. Thomas Lee, thank you very much. Thanks, everybody, for joining us. Bye for now.